There's a little bit of a disturbing trend in real estate, isn't there? You feel it, I feel it. Let's talk about it. Welcome back, my name is AlexBeltran, and today I'm talking about real estate. I don't know if you know this or not, but real estate, it's kind of my job. It's kind of my job to look around at different properties, trying to sniff them out like a truffle pig, you know what I'm saying? But lately, all I've been finding are some, pretty troubling trends. Now, I've been finding properties with like multiple mortgages, and not just like one or two, but like 3 to 4. And not only that, they're sky-high interest rates, and they're adjustable. Like, I didn't even know adjustable rates were really a thing anymore. That was like a 2008 thing, and we know what happened then.
That's America's housing market.
And because these mortgages are kind of wishy-washy, I guess is the best way to explain it, the only real way to exit these properties without having to write a check at the end of escrow is for like the property value to literally double. And I don't see that happening anytime soon. Now I get it. You must be wondering to yourself, Alex, you freaking nerd, why are you looking at people's mortgages? Well, you know, it's actually one of the ways that I like to shop. See, I like to shop subject to existing loan, seller finance, as well as like the more traditional, what's the bigger pockets way of saying this? BRRRR strategy. I like to get creative as well. And part of that is looking into the type of debt that the seller holds to see what type of deal, you know, we can come up with that is beneficial to them and beneficial to myself as well. It's really kind of the only thing that gives me a competitive edge in this particular market. Now, I know what you must be saying. What is subject to existing loan and what is seller financing? Great question. Go to Pace Morby's channel because he's way better at explaining it than I am. I know it's kind of weird bringing this up, but do you guys remember that monologue on The Big Short where Bennett is talking? I mean, that's what a monologue is.
They saw the giant lie at the heart of the economy, and they saw it by doing something the rest of the suckers never thought to do. They looked.
Well, once again, we have life imitating art, because I don't know if you heard this recently or not, but 6 major rating agencies were fined for, and let me quote this correctly, significant record-keeping failures. That's kind of a big deal. Now, easy there, cowboy. I'm not saying that the market is about to collapse. All I'm saying is that the numbers that are being presented to us by the housing authorities, and yes, even the National Association of Realtors, seem off. In a previous video, I talked about, you know, numbers seeming off all the time and actually how it's kind of normal. Video linked above. But this time, like the high interest rate and the multiple loans, which, don't get me wrong, I get it. A lot of people get multiple loans for their property for several different reasons. But this time it seems like severely underreported, if not like completely ignored altogether. Couple that with the price drops that are trending all over the country. Yeah, that like whole rating agency thing seems pretty suspicious. And look, the reason why I'm not freaking out claiming that the economy is going to collapse is because as long as these owners stay in their houses and keep paying off that debt, then who cares, right? It's just multiple loans that they have on their property. However, these homeowners can't even like rent out their properties to cover the amount of debt that they have on their property. If they sell, there's a high likelihood that they're going to have to write a check at the end of escrow. Once again, not a big deal, because keyword there is if they sell. However, short sales and foreclosures are kind of making a little bit of a comeback as well. This is problematic for several different reasons. See, I'm a real estate investor and I like solving people's problems. The more problems I solve, the better it is for the people around me. But I look at these properties and I don't see a viable exit strategy, like in any way. Even if they rent it like, you know, midterm rentals or rent it out by the room or whatever the latest fad is to get the most amount of money in rent for your property, even then it still doesn't cover it. I mean, like maybe, who knows, right? Like maybe they did invest in something that is outpacing the interest rate of their loans. But we're not exactly seeing that, are we? 62% of Americans are in the stock market either directly or through their 401ks. The average return on investment is between 7 to 9%. However, a lot of these loans, they're between 6 to like 7.5%. I mean, I get it. They're outpacing the loan by like 1 to 3%, but that still doesn't sound right, does it? I mean, take a little bit of a deeper dive, right? I mean, if you think about it, yeah, our 401ks are up, but that's like on paper. And that's only because of the amount of money printing that we've had within the last couple of years. You feel this, I feel this. Once you start adding the fees of a 401k, forget it. Your like gains are dwindled down significantly. Car repos are up, delinquent bills are up. All this is pointing to the fact that these loans are funding liabilities, not assets. As always, this isn't about predicting the market crash. I don't think there's really a way to do that. If anything, the Federal Reserve has proved that if we're in trouble, they're willing to like turn on the money printers. Whether that's good or bad, that's a discussion for a completely different day. We just know that they're willing to do it. The real truth here is we don't know what's next. We don't know what's coming. All we really know is that it's better to have assets rather than liabilities. Surprise, surprise. What I'm really trying to get at is pay attention to these particular properties, keep an eye on them, put them in a CRM, check on them once a month, twice a month, whatever the case may be, because who knows, maybe these properties might be coming on the market in one way or another. And if you're prepared ahead of time, you might be getting a pretty good deal on these properties. That's all I'm saying. And at the very worst case scenario, there's a high likelihood that if these debts persist, you might be at the courthouse steps buying these properties at foreclosure at a very deep discount, which is something that I tried doing the other day. Unfortunately, I wasn't able to purchase that house. Go ahead and check out that video, linked above. I'll catch you guys in the next one. Peace. Shh.